Hi everyone, and welcome to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. But all that I can say right now is that this has been a harrowing week. Remember last Friday when we talked about the overall market and I showed you our table of values which showed that the NASDAQ was close to providing a confirming sell signal on the overall market at the 10,800 mark, which is its bubble price, or 7.4 times its adjusted book value level. Since then, the NASDAQ repeatedly stepped right down to the edge of its bubble price and then pulled back. We are hoping for a tradable rally here, but never want to prejudge what the market has in mind. Okay, 4 things today. As always, remember to like this video, and if you haven't done so already, you can subscribe to our YouTube channel to make sure that you get these videos every Friday as we publish them. And if you'd like to make a comment, don't be shy. I love reading what our viewers have to say. And last week's comments were great, so keep it up. Secondly, last week I said that the FANGs were really starting to concern me. The average FANG stock was off some 18% on average since their price peaks. And with the exception of Facebook, we're all on the verge of giving us a sell on the overall market itself, if I can assume that their leadership remains an important aspect of the current market. So this week was going to be important, and today we'll see what did happen. Third, I mentioned that on September the 30th at 11:20 a.m., I will be speaking at the Money Show, Canadian Virtual Expo, a live online conference. Note that the registration is free. I will be speaking on black hole economics, why the rich are getting richer and you are getting poorer. In one of the most ironic twists of fate in all of economic history, the COVID-19 collapse occurred just as the U.S. economy was heading into one of its potentially nastiest setbacks that one could have imagined due to the dead weight of counterproductive debt that Trump and the U.S. Fed has placed upon it. I have to note that the full recovery, that is back to 2019 levels, is not only not possible, but also worse things may yet be in store if history is any guide. I'll put a link in the description so that you can register and watch my full video. Finally, FANG Friday has, well, sort of snowballed, and there are a lot of new viewers, some of whom may well be baffled by what they are seeing. So I would like to take 2 minutes right now to guide them through a little bit of the SVA valuation parameters. That's short for structural valuation analysis. Clients who are watching this should already know this, and you could consider it as a refresher. But if you aren't a client and have been watching but haven't been able to kind of fully wrap your head around our valuation system, hopefully this will provide a better grounding as you learn more about SVA. So, first, SVA is a merger of fundamental and technical analysis, meaning that there are strong elements of both in the service. Second, the work flows from a mathematics which we term accounting dynamics, meaning that the SVA service is balance sheet based. Third, those lines on the chart, which I call breakpoints, are not statistically derived. The numerical values that you see flow from the mathematics of accounting dynamics, and the values are the same for all companies in all times and in all jurisdictions that we have ever investigated, from Australia through to Zimbabwe, and including China and even Russia. They're all multiples of adjusted book value, and they are, in essence, the support and resistance lines that you find in technical analysis. What I'm saying is that SVA is the theoretical and mathematical underpinning of technical analysis. Fifth, I should add that the SVA analysis is applicable to the broad indices as well as individual stocks. And that allowed us to identify the precise lows for March, for instance, and also what may well turn out to be the peak of the current bull market. Finally, if you subscribe to our service, I usually spend an hour or two doing an introductory webinar with every new client, and I send you the manuscript of my unpublished book, Inside the Market, which lays out in gory detail all the elements of the analytical work. Finally, just as a reminder, for those watching FANG Friday who are not yet SVA clients but want to take the next step and join us, send us an email outlining where you are on your investment journey. With that in mind, let's take a look at the FANGs. Okay, well, starting off with Amazon, not a necessarily pretty picture, is it? Amazon tried 2 times to break above its HB4 price and failed on both counts. The second time, the stock has got about halfway down to its HB3. Okay, that is 16 times book value. In fact, it's about just dead halfway between the two of them. Microsoft, well, Microsoft tried actually just almost a dead image of Amazon. Also tried to break out a couple of times, and it too has failed and would have very much appeared to be heading lower. NVIDIA had a beautiful breakout, but look at that. It has set back to its HB4 price. Okay, that's 20 times book value and appears to be failing there as well, although it's close enough to the line that I would think that if we got a strongish kind of a rally in the market, it may sort of pull itself back over that breakpoint line. And finally, Netflix. Well, Netflix has been our bugaboo for some period of time. It gets up to the HV4, wouldn't break out. Then when it did break out, it promptly collapsed right back down again, and tried again. It's doing the same thing again. This is what we call sloppy trading, indecisive trading, and in the past has typically led to lower prices ahead. Okay, of the 3 stocks that actually gave us clear sell signals, let's start off with Facebook. And again, looking back over the past 2 odd years, you'll see that Facebook came right up hard to its bubble price. Okay, that's 7.4 times book value, and as it did back in 2018, promptly set back again. Now the stock has not reached support at its mid-super growth price. That's 5.5 times book value, and may well have a nice rebound at that point. However, that we will have to see. Alphabet, well, same thing with Alphabet. Now, for the new viewers here, you'll see that Alphabet did not get to its breakpoint, its mid-super growth price, 5.5 times book value. But nonetheless, I kept saying I think that this stock has had it for now, and we're likely to get a setback. And why was that? Well, if we look at the longer-term history of Alphabet, we will see that the stock for years and years and years has struggled to get to its mid-super growth price and has failed every time. So when it tried one more time, quite frankly, I didn't believe that they were going to make it, and indeed it has not made it. The issue right now, however, is that the stock has to hold at the low super growth price. Okay, that's 4.5 times book value, and it's just a little wobbly right there at the present time. Finally, Apple. Well, here's Apple breaking out on that news that they were going to split the stock, and the stock. Look at that! It just popped right out over the HB4 line, and in the next 4 weeks went all the way to its HB5 price. Okay, that is 26 times book value. However, that was it for the stock, and having spent 4 weeks going up, is now spent 3 weeks coming right back down again, and it is sitting right there, okay, at its HB4 price. So as we wind up the week, things are worrying, but maybe there's light at the end of the tunnel for the moment. Amazon has fallen off its fence and is dead in the middle of its recent range, and it looks to be heading lower to its HB3, where I would expect that we will get some quite decent support. Microsoft, like Amazon, looks as if it's abandoned all hope to get any further and is retreating back towards its HB1 price. That's 10 times book. Netflix again made a try for glory, hasn't succeeded again. Nvidia, after a very promising breakout, not only set back to its HB4, but broke back through that level. Now, it too could recover if a market rally can persist. I have to say something, however, about those 4 stocks. I do not like to see general valuation failures. That is to say, companies coming back down to support levels and then breaking through. 1 or 2 is understandable, but 4 becomes a real issue. Of the 3 stocks that did reach our upside targets, all have set back, and at least one, Alphabet, may be in the throes of a further breakdown. Although, again, if we have a good rally, perhaps it'll kind of pull that stock back over the line and obviate that breakdown. Facebook reached its upside target, its old high at the bubble price, and is in full retreat towards its MSG price, where I think it will have at least a decent tradable bounce. Alphabet got to my targeted valuation level, not quite to its MSG price again, and set back as I thought. But it's now struggling a bit at its LSG price. And finally, Apple hit its HB5 price, that's 26 times book, and set back 1 full breakpoint. And so far has hit and rebounded perfectly up off the HB4 cusp, that's 20 times book value. However, now that HB4 price needs to hold. By way, I'd like to remind both our new subscribers and the old hands, the market works with whatever balance sheet it is given. It does not invent potential changes, and that is important for Apple investors in particular right now. I expect that further share buybacks in the coming quarter may lower the HB4 and the HB5 price levels, and the dead hits that you see now will disappear as we look back in retrospect. Okay, and let me just show you what I mean. Here we are. Okay, here is the company beginning its share buyback process. All right, and what has happened is that it has allowed the company to move higher and higher as its ROE grows. However, what you'll see here, and in fact, let me go back to the very short-term chart. What you see here is that we got a dead hit on its HB5 and then another one at the HB4. However, okay, in the period ahead, we are likely to see further share buybacks, and therefore we are likely to see that downtrending balance sheet is going to continue. Okay, and therefore, in retrospect, it's going to look as if the company actually broke out. Well, let me tell you, it didn't. Some people complain that balance sheets don't represent reality and should be altered for this, that, or another reason. Inflation, don't like the goodwill, mark-to-market values, whatever. I'm going to say it again, only differently. The market only works with the hard facts that it is given, not what you or anyone else think it should be. Anyway, now some market observations. As I said last week, the market may have already reached its extreme. The market is represented by the S&P, missing our precise super growth price, the SG price target. That's 3.5 times adjusted book value by only 2%. And therefore, maybe we should call for an overall sell on the market. However, historically, in order to get an overall sell signal in the market, we need to have a break in the NASDAQ 100 as well in order to confirm a top for the S&P 500. And that breakpoint value occurs at 10,800 as of last week, and we were exactly there. I admit that I am concerned about the height of the market. And I observed then that the NASDAQ bubble price must hold at 10.8 or it's all over. That, by the way, that's 7.4 times book, which if our new viewers would like me to define that with mathematical precision, is 1 over E squared. There, aren't you glad you asked? In this past week, the 10,800 mark was tested multiple times and so far has held in. And in fact, today it looks as if we're having maybe a decent rally up and away from that. How important is the NASDAQ confirmation? If I go back to 2008, all the way during 2008 up until September, the S&P kept telling us that a bear market was coming. But it was not until September that the NASDAQ agreed. And when it broke in early September, things got very unpleasant. Anyway, I've said it before and I'll say it now. SVA is an ideal source of information and support to get you through a bear market. And bear markets need not be nearly as scary as they sound. If nothing else, you may wish to check out your own portfolio and see how safe you are. Anyway, if what you've seen has interested you and you'd like to see what your own stocks are telling you, then send us an email at info@strategicanalysis.ca. Clients get a lot of benefits, not just the 3,000 charts of North American stocks, but daily commentary, trade ideas, weekly webinars where we go into the nitty-gritty details of how to use the charts in order to become a better investor. When you sign up, I will personally take you through our system on a one-on-one video conference and show you how to use our system to become a more confident and profitable investor. If this sounds like something that's in line with your goals, let's take the next step together. For now, this has been Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you've got the right tools. Hopefully, we are starting a pre-election rally today and we can all relax for a bit. So, have a good week. I'll see you next Friday, if not sooner, on The Money Show.